Bhargav Dasgupta, who's the Managing Director and CEO of ICICI Lombard General Insurance, joins us to talk about their business, talking essentially of the market share gains they've seen. Market share growth in non-life insurance segment is likely to only increase from here. What is their growth strategies? What we will be discussing with them, and the opportunity in the general insurance space in terms of growth via the inorganic route is also something that we would like to take up with him over the course of the next 10 minutes. So Dasgupta, it's great to have you on the show. Thanks very much for taking out the time. We did a GDPI growth of 15% for FY18. What's your outlook on gross direct premium income growth for the next 1 or 2 years, and what will be the key drivers for the same?
So, the way we look at the market is with a slightly longer term view of 3 to 5 years, and what we find is within that period there may be some years of some fluctuation in terms of some high growth years, some slightly lower growth year, but on an average what we believe as an industry, the non-life industry will grow at between 15 to 20% over the next 5 years, 15 to 20% CAGR. Now, within that, on a certain year it may be low, as I said, another year it may be high. This year it looking like probably the lower end of that range. Couple of factors. One is the third party price increase or the lack thereof has had some impact of motor growth. The other lines are doing well. Health is going pretty well. Crop, we'll have to wait to see what happens in terms of actual numbers. But overall, as I said, over the next 3 to 5 years, this industry we remain very optimistic about 15 to 20% growth CAGR.
As an industry player in insurance sector, what's your view on government health insurance schemes? Do you see better demand for health insurance? How do you see it benefiting players like you who do have the exposure to the segment?
Look, before I talk about from our perspective as health insurance provider, let me first say that this is honestly a very, very important, vital initiative from the overall healthcare perspective. I mean, provision of healthcare for a certain strata of our population. For that segment, today there is really nothing in terms of paying for their healthcare costs. So whether it works for insurance or not, that's a subsidiary issue. I think the most important national issue is that it's a very, very positive development from that segment of customers. Now, coming to your specific questions of what it will do to insurance, of course, it's a new scheme that has been launched. It will come in terms of a sizable chunk of premium. Now, what we will have to look at it as an individual company is the long-term sustainability basis the pricing that we find being quoted for the scheme. And our view is that if you want the scheme to survive and do well over a long period of time, it has to be sustainable from all stakeholders' perspective. It has to be sustainable for insurance companies, without which it won't survive in a suitable manner. Because to be able to provide quality service, you need it to be sustainable. I'm sure the providers would have similar asks, and they have within limits. I think some of that issues need to be addressed. So overall, it's a very good initiative. In terms of the specifics of the scheme, benefiting us as a company specifically, we'll have to wait to see how the pricing is. Of course, it will benefit the overall industry because it's a new chunk of premium coming into the industry.
So within your product mix, you have dominant exposure to health, motor and crop insurance. How do you see the product mix changing? Yeah,
so you're right in terms of analyzing our product mix. Honestly speaking, that largely maps the market in aggregate terms. If you look at motor insurance, it would be about 40 to 45% for the industry. We are around 40%. Health would be slightly more than our number. We are roughly about 20%. So it's almost similar to the industry mix. What we see going ahead is that the motor, the corporate lines and the health lines will probably grow faster than the other lines. Because we are seeing a consistent, steady growth in health insurance, not just for us, but for the industry. And we see that as an opportunity for us as well. Clearly, we want to focus on the corporate segment, where the pricing is improving, and that's something that we see grow really well. Motor insurance this year may be a bit slow for the reasons that we talked about in terms of motor third-party pricing increase, but over the period that should also keep on doing well.
So while the solvency ratio is fairly comfortable at about 2x, how sufficient are you to capitalize capital to support growth for next 2-3 years?
So, if you see our solvency as of the end of last year, it's more than 2, it's already 2.05 as against the minimum solvency requirement of 1.5 times. Given the growth trajectory that we see, as also the profitability that we have as a company, we don't see the need for enhanced capital requirement for our normal business growth at this point in time for the next 2 years.
Okay, your ROE has remained healthy at 20% for the last 2 years. Is there scope for further expansion? And if so, what according to you would be the key drivers?
You see, if you see our track record over the last couple of years, we've been delivering around 20% ROE consistently. And that's largely been driven by the fact that our underwriting performance has been improving. If you see last year, our combined ratio was roughly about 100, 100.2, a significant improvement from what it was the previous year, in spite of, pretty bad losses on the crop side. So we had, very good performance in the rest of the business. And we believe that that's a number that we want to sustain. Now, our business by design is volatile. There could be a year of bad catastrophic losses or crop failure, in which year your combined may suffer. But if you look at over a long period of time, the number should sustain. Just to give you a sense, over the last 10 years as a company, our profit after tax growth has been more than 23% CAGR. And this has been at a time when the market has been, under some amount of pricing pressure. Combined ratio for the industry has been quite poor. In spite of that, we've had a profit growth of close to 24% over the last 10 years. That's, we believe, quite an amazing number. And we believe the industry continues to give us good opportunity to sustain performance going forward.
Okay, so since you are the fourth largest private market player, where is it that you see your market share, say, over the next 2 years? And any inorganic growth plans that you may have to increase your market share presence?
Look, market share, our stated objective has been that we want to grow in line or slightly above the industry growth. Our growth numbers will moderate based on how the industry pricing environment changes. In a very aggressive pricing environment, we may not grow in line with the market, and vice versa. So as we speak, given the environment that we see, we want to grow slightly ahead of the market growth. That's our stated objective. In terms of inorganic, we are always open, but it has to make sense for our shareholders. It has to be at the right price for the right franchise.
Would there be any plans from ICICI Bank to further reduce stake in ICICI Lombard? Also, would ICICI Lombard be looking at any strategic investment opportunities then?
I don't know what you mean by strategic investments. As I said, we are always open to inorganic opportunities if it makes sense. Otherwise, there is very limited strategic investments that we can do given the investment guidelines that we have, in the current regime. So I guess you're talking about inorganic opportunity, which I've already addressed. As regards ICICI Bank's plan, at least as far as we know, the stated objective is to maintain the shareholding at this point in time.
Okay, thanks very much for joining us with a deeper understanding of your business and sharing with us with your business plans.